Many investors, people watching this video, think that capital gains are something to fear. But in many situations, they are actually one of the most tax efficient ways that you can generate income from a portfolio, and understanding how they work can completely change how investors think about taxes and withdrawals. Something that people do not typically understand very well is that there are basically two different tax codes. There is the income tax code and the investment tax code. They work hand in hand in some ways, but in many ways, and for most investors, they tend to work separately for the most part. I know that sentence didn't make complete sense. So for example, if someone is married and earning around $150,000, they're likely in the 22% ordinary income tax bracket. Because they're in a higher income bracket, I often hear that they're scared to capture a gain from their portfolio. However, a long-term capital gain does not suddenly push that income into a higher tax bracket. This is because the capital gain, when captured, is only taxed at your capital gain rate, and it's not taxed at your income rate. In fact, capital gains will not increase your regular income tax bracket. The capital gain tax brackets are much simpler to understand, and likely they're actually cheaper than paying income taxes in many cases. I'm your host, Eli Freeman, a certified financial planner, and this is Data Brief, where we break down the data behind investing so you can make better decisions based on facts and not feelings. So under the 2026 tax brackets, a married couple would need total taxable income to exceed roughly $613,700 before any portion of long-term capital gains begin to be taxed at the 20% federal rate, meaning a couple earning around $150,000 could potentially realize several $100,000 of long-term capital gains before reaching that top capital gains bracket. Keep in mind, the tax brackets adjust annually, and this discussion today is based on 2026 federal tax brackets. So let's break down why capital gains are not as bad as many people think and how they actually work. First, long-term capital gains are taxed under a completely separate rate structure from ordinary income. Instead of being taxed at 10% all the way through 37% for high income earners, long-term gains are taxed at 0% to start, 15%, or 20%, depending on total taxable income, with only one small complexity that I'll describe later. This means that many investors who assume they are paying 22% or 24% on capital gains are actually paying significantly less because they're only actually paying 15% on their long-term capital gain. One of the most overlooked opportunities is the 0% capital gains bracket. In 2026, a married couple filing jointly can have taxable income up to approximately $98,900 and still pay zero federal tax on long-term capital gains and qualified dividends. This 0% bracket can create a powerful planning window for retirees, especially early retirees or investors who have low income years where they can rebalance portfolios or generate income without triggering federal tax on gains. In practice, this is really rarely utilized. The reason for this is if someone finds themselves in the 0% bracket, this is typically an opportunity for Roth conversions. So all of the capital gain that would be captured at 0% tax ends up taxed at 15% because the individual increases their income by converting their IRAs to Roth. For example, the time when someone would be in the 0% bracket is the window of time when they retire but haven't started their retirement income sources like Social Security, pensions, annuity income, or IRA distributions. In that window, an individual's income bracket is likely very low, especially if they have after-tax money to provide their income. This means they could potentially be in the 0% bracket, but if someone is in the 0% bracket, I think most of my viewers would agree that's a great time to move money out of a pre-tax account and pay the tax on it. So for many people, they never make less than the 15% capital gain bracket if they're doing planning because they take advantage of those low income years for their Roth conversions. Besides the 0% capital gain bracket, the next and most common capital gain bracket is the 15% rate. For married couples filing jointly in 2026, this 15% bracket starts around $99,000 of income and goes from $99,000 all the way up to $613,000 of taxable income. That covers the vast majority of investors and clients. When people say they are afraid of realizing gains because they're in a higher income tax rate, they often do not realize that their long-term gains are still likely taxed at 15% rather than their ordinary income rate. For a majority of people, they will be in the 15% capital gain bracket for most of their life. They will not go above the 15% bracket because the bracket is so high in income, and they will not go beneath it because those are great years for Roth conversions or tax planning. And Social Security or pensions will typically not allow for low enough income to be beneath the 15% bracket. And this is a big deal. So many people will find themselves thinking they're minimizing their taxes by not selling a stock or a position, and I often see this as a reason not to sell an investment that people wish they could sell or are needing to sell, but they won't because of this tax. But please, take a second with me and zoom out. If you, the investor, will always be in the 15% capital gain bracket, then there is never a time that you will pay less and never a time that you will pay more. The idea that you should wait to capture gain in a lower income year goes out the window. You, as a good investor, should not let the tax brackets change a good investment portfolio or allocation. You should not delay making portfolio changes just because of a tax bracket. And this could be especially true of the capital gains tax bracket. Do you get my point? If you will always pay the same tax on the sale, then make the best investment decision because the tax will not change, but the investment could. Now, a savvy planner watching this video will be able to poke holes in that methodology, and they would be correct. So let me talk through a few variables that I've seen that could change what I just said. The first is that there is a net investment income tax on capital gains if your income as a single person is over $200,000 and if you're married and it's over $250,000. Effectively, this means that there are 4 capital gains tax brackets: the 0%, 15%, 18.8%, and 23.8% because the net investment income tax is 3.8%. I personally, in doing planning with many clients, have never seen an individual or couple in the 20% capital gains bracket without paying the extra 3.8% net investment income tax. The second objection to my statement is if someone is 63 or older and will be utilizing Medicare, capital gains can impact their Medicare statements or premiums through IRMAA. IRMAA is where your premiums become more expensive because your income is too high. This, in practice, is basically just an additional tax because your income is high, but it happens 2 years after the year that your income is high, so it can be fairly tricky to keep track of. The third objection is if someone passes away, their beneficiaries receive a step-up basis in their stocks and assets, and they do not owe capital gains tax upon inheritance. This is because when they receive the assets upon inheritance, it's stepped up to fair market value. And this is a great argument for individuals to not sell positions if they're very late in life or if they're in poor health. The real takeaway is that capital gains are often misunderstood, and they're frequently overestimated in terms of their tax impact. When used intentionally, they can be one of the most efficient tools for generating income for a retiree. They can also help you manage tax brackets and create a flexible withdrawal strategy from a portfolio. Instead of automatically fearing capital gains, investors should look at how the investment tax code interacts with the income tax code and recognize that in many real-world situations, long-term capital gains are taxed at 0% or 15% and may be significantly more efficient than taking income from other sources. As always, the goal is not simply to avoid taxes this year, but to manage income strategically across multiple years to create the most efficient long-term outcome. Continue to look at the data because understanding how capital gains really work can completely change how you think about portfolio income and tax efficiency. Thanks for watching this episode of the Data Brief. If you enjoyed this video, I have a video that describes the changes in the tax code for someone who's working versus someone who's retired, and you can click here to view it.